What's good, everyone, and welcome back to the Financial Forward channel. We are on our free money glitch series number 1, talking about the third part of fundamental analysis, company valuation part 1. In this portion, we'll learn how to apply the term earnings per share, the importance of price to earnings ratios, and how to learn the value of a company. So grab your notebooks, buckle up, hands and feet inside the ride at all times. Let's go glitch this money. So we can begin to analyze the different companies inside the sectors after we understand which sectors are expected to perform best at different stages of the economy. A trader has to pay the market price to own shares, but how does a trader know if they are trading or if they're paying way too much, right? A share can be overpriced, it can be underpriced, or it can be fair market value. So we must use certain techniques to analyze individual companies and help us as investors. With that being said, though, each business in the market sector will not always perform equally. Okay, so you could use you could have a financial analyst to value things for you, but the problem is that financial advisors and analysts must be knowledgeable in all types of financial documents, including balance sheets, profit and loss statements, and other documents. Analysts are specialists in a particular field, so the average investor shouldn't expect them to have a deep understanding of the market, right? Using a financial advisor can be good, but it's not the only method to value a company, because all investors have access to tools that can simplify the process and give them a clear understanding of the state of the company's finances and future prospects. So when creating or managing your portfolios, you as an investor can choose which shares to buy by using some tools we'll look at today. Okay, so the first tool is earnings per share. Let's begin with this. So earnings per share is a metric that compares a company's net earnings over a specific time period to the total number of outstanding shares, right? The number of company shares that shareholders owns affects the company's net profit after taxes, right? So an organization will benefit from a high earnings ratio because it indicates that it has more cash available to pay dividends to shareholders, right? But there are some factors that EPS ratios do not account for. The only metric used to assess whether a share is a good investment should not be the company's financial standing. Okay, because year-over-year growth in earnings is viewed as positive, the ratios can be deceptive, right? Repurchasing its own shares is one of the ways for a company to lower the number of outstanding shares. So it's possible for the earnings per share ratio to rise without the net income doing so. With that being said, though, the amount of the company's debt is not considered in the calculation, right? Without an increase or decrease in sales, a change in market conditions such as rising or falling interest rates can negatively impact a company's profitability. So an important factor that is ignored when calculating earnings is the amount of capital needed to produce the income. I say all that to say this. The calculation does not take efficiency into account. So if two similar companies have the same earnings per share, but one uses more capital to generate income, the second company would be more efficient and is probably the better prospect. Okay, so all in all, earnings per share determines how much of a company's net profit can be allocated to each share. So to choose which shares to purchase, we basically should consider this data along with a company's profitability. Okay, then there's the price to earnings ratio. So the price to earnings ratio is a gauge for a company's current share price, right? The current share price divided by the earnings per share equals the PE ratio, okay? The PE ratio, price to earnings ratio, is regarded as one of the most important metrics for a company to compare its value to past performers or to other companies in a similar industry. So the company's per share, the PE ratio helps in estimating a company's value. And this knowledge enables investors to make informed decisions based on earning potential, because a higher PE ratio indicates a higher growth prospect, right? Although investors tend to view high PE ratios favorably, it's very important to realize that this data cannot determine whether a share is overvalued or undervalued on its own, right? The PE ratio just determines how long it would take for a company's earnings to recover the current share price, right? So, for example, let's say Apple's current share price is $100 and its earnings are $5. Well, the PE ratio would be 20. The company's earnings would have to increase by 20 years in order to catch up to its own share price at the current PE ratio of 20. A lot of variables like changes in the PE ratio from year to year, steady earnings, and share price volatility will determine whether or not this number is a good one. Okay, so if earnings are stable and the price of the stock remains constant, then the PE ratio is unlikely to experience big ups and downs. Okay, and so as you can also see here in this example, the PE ratio may be 20, but it cannot be viewed with the same level of confidence as the PE ratio of Apple if we're contrasting it with a company in the same industry that's highly volatile, that has wild fluctuations in the share price and has inconsistent earnings. Okay, so what does a high or low ratio tell you? Okay, because it's important to understand the dynamics of why a high PE ratio suggests potential for higher growth. So with high PE ratios, because investors anticipate high levels of earnings in the future, a high PE ratio shows that the share price has increased more quickly than the company's earnings. Although it can be true, this expectation raises the value of the share price. So when this expectation isn't realized, though, the shares will suffer abrupt declines that will far outpace those of the market as a whole. Now, with PE ratios that are low, this means that the share price has decreased. Okay, share prices may drop for a variety of reasons unrelated to the particular company, but the business may continue to turn a profit, right? So it's crucial to remember that larger businesses typically distribute a significant portion of their profits as dividends to shareholders. So that will lower the net income and will lower the PE ratio than for businesses that pay little to no dividends, right? This is when investors find real value in shares at this point, as they can still provide good value through dividends. Okay, so what is the best PE ratio? I mean, since PE ratios can differ significantly from company to company and sector to sector, there's really no simple solution. It's a good idea to compare the PE ratio of the company you're analyzing to those of companies in the same industry, the overall index or the sector index. As you can see in this example, silver may be cheaper if its PE ratio is 20, while the market sector ratio is 29, suggesting that silver may outperform its peers in the future, right? But if silver's PE ratio is 40 and the market is 29, it can be a sign that silver is overpriced in comparison to the material sector. However, though, investors shouldn't rely solely on the PE ratio. Why? Well, since it doesn't take into account crucial details like debt levels and dividend yields or market cycles in this calculation, the ratio can occasionally exaggerate a company's positives and negatives. Okay, we're going to pause here for now. The Free Money Glitch fundamental analysis on company valuation continues in part 2. Like, comment, and subscribe. I love y'all. From yours truly, Financial For.